Hi, I'm Shannon, Grein, an economist with Wells Fargo, and I'm joined today by senior economist Tim Quinlan to discuss our latest forecast. So Tim, since our last update in November when we published our annual report, the data hasn't really materially changed regarding what we were expecting. So third quarter GDP came in above 5% at an annualized rate, and data is tracking to grow closer to a 1% pace in the fourth quarter, so somewhat of a moderation. But maybe you could just start us off by giving us the highlights of our forecast.
Sure. Yeah. So for what it's worth, we do still have a mild recession intact. As recessions go, this one is about as mild as one can be imagined. The thing that we kind of urge our readers and viewers to kind of keep in mind is that the specifics on whether or not we actually pull off the soft landing or have a mild recession is sort of less important than the fact that it's just kind of going to be a crummy year. You mentioned the 5.9% annualized growth rate in the third quarter, and you might come away with that with the impression that, gosh, this economy is kind of ripping. What's the problem here? Our bet is by the time the dust settles on 2023, you'll see that equipment spending declined in 3 out of 4 quarters of the year. That's kind of emblematic of a recessionary environment in the manufacturing space, which you and I have written about and talked about in the past. What's holding things up is the consumer, and to varying degrees, some of the things that propelled the consumer to get where we are may not be as intact going forward, particularly the fact that consumer credit's no longer really cheap and widely available, and excess savings is kind of drying up. But as we've talked about, it's really the labor market that will become the most important driver, not just of the consumer, but really for the whole economy. So what are we seeing on the labor front, and how do you think that plays out?
Yeah, so the labor market is still extremely tight. I think that's exhibited by the number of jobs being added per month, the unemployment rate still being relatively low despite it ticking up more recently. But if you look beyond those headline figures, there is some increased sign of moderation under the hood. So you have job openings continuing to come down each month, small businesses hiring plans returning back to pre-pandemic levels. You have the quits rate returning to pre-pandemic levels, which you've also seen the uptick in continuing jobless claims. So those people who are losing their jobs are finding it a little bit more challenging to find a new one today. So I think the early signs of moderation are there, and the list is sort of getting longer in terms of moderation in the labor market. And in some ways, that's what the Fed is looking for with tightening policy. So they want to slow the labor market to be more consistent with their 2% target on inflation. And we have seen continued progress on the inflation front, with the CPI data for November continuing to show a slower pace of price growth, and the core measure, still remaining at 4% at an annual pace. So 2 times the Fed's target, but off the peaks we saw. So I think both sides of the mandate are coming back towards target for the Fed, and I think that might take some of the pressure off of the Fed as we go forward. So what are our latest expectations in terms of Fed policy?
Yeah, well, going into the December Fed meeting, it felt a little bit like, gosh, maybe financial markets have gotten a little bit ahead of themselves in terms of expecting a more dovish pivot from policymakers at the Fed. This all kind of started to materialize over the past couple of months. We had kind of a soft CPI report, and some comments from Fed policymakers that started to coach expectations toward this somewhat more accommodative bent. And in the actual event, when we got to the December meeting, the Fed kept rates on hold. This now marks the 3rd meeting in a row where they've not made any additional rate change. And they technically left the door open to a potential additional rate increase if warranted. But gosh, Shannon, judging by the summary of economic projections, the way the dot plot shifted, that's not anybody's baseline expectation. And the comments from Jay Powell in the press conference after were so dovish that an initial drop in interest rates, primarily in the middle part of the curve between 2s, 3s, 5s, all of those were down maybe 20 basis points, probably the biggest one-day move of the year for this part of the curve, and kind of reaffirmed by the dovish position articulated by Fed Chair Powell in that press conference. So their next move and our forecast, and I think now in the expectations of financial markets, is to head lower. Just how much lower is kind of a function on how things play out with the economy. If you do get kind of a bumpy landing, as we anticipate, probably you get more rate cuts next year. To the extent that they're able to pull off this soft landing, then maybe the rate cuts aren't quite as steep.
Well, Tim, thanks for joining me. And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.